Tell us more about Allianz Flexi Asia Bond.
Flexi Asian Bond Fund is essentially a fund that invests across all the asset class of the Asian fixed income space. So we can go into high yield, we can go into investment grade, local currency, corporates or sovereigns. There's no benchmark constraint, so technically we asset allocate across all the different fixed income asset classes.
What is one thing the investment team does in this fund that not many investors know about?
We are an active conviction approach manager, and that differentiates us from the traditional buy and hold manager. We actively asset allocate across investment grade, high yield, local currencies, and even to cash. Cash to us is an asset allocation tool. We also take advantage of short-term opportunities in currencies, as well as capitalize on relative value opportunities that exist between investment grade bonds as well as high yield bonds.
What is your outlook on the opportunities in Asian fixed income, and what are the drivers of the fund's performance moving forward?
Firstly, the oil price has actually declined right now to about 56, so inflationary pressure has declined also. Current account pressures have also declined. Fed is on pause now, so there's a change of stance. China is on easing mode. There's a change of stance also, and you have also the trade dispute between US and China resolving. That has actually brought about, this lifted sentiment quite a bit, and the market has rallied on that note. This brings us to our positioning. We are fairly sanguine on the US dollars. We think US dollars has peaked out for the time being, at least for the first 6 months or so. That should consolidate, so we find opportunities in local currencies. For the local currency bond side and the rates, we think it's rallied quite a bit, and right now we're having a short position in most of the local currency bond markets generally. However, for credits, we're still very constructive. We think credits, particularly high yield, are still trading on the cheap end of the market, and therefore we'll still have a little bit of ways to go for the year.
Will the portfolio seek to trim exposure to the Chinese real estate sector or add more into it?
Actually, the valuations of the real estate market are very attractive right now, so we are still very constructive on the sector. The sector as a whole is a very important part of the Chinese economy. If you add, both the property sector as well as the supporting industry, it constitutes about 30% of the Chinese GDP. As a result, we think that itself is important enough for the Chinese government to sustain it, right? So we will not see a collapse in the sector. Whether we will add more on the sector itself truly depends on the valuations of the new issues that come out right now. Right now, we're just maintaining where we are on our current exposure.
Don't forget to follow us on our social media sites for more investment ideas, and comment down below for what you would like us to cover next.